All right. So ever since the news has released information that the FHA or FHFA has released the new LLPA pricing, the media and the housing market and the mortgage industry has just been having a field day with this. And with me to discuss this in greater detail, because I think there's a lot of, what the FHFA director Thompson is calling misinformation is actually being taken out of context. And this episode, what we're going to talk about is clarifying everything on this whole new loan limit pricing adjustments. And so with me to discuss that in great detail, Mr. Steve Frost from National Mortgage Funding. Welcome back, my friend.
Thanks for having me, man.
Absolutely. So first and foremost, let's just, for anybody that is not aware, quickly, we'll just tee this up. On May 1st, these new loan pricing adjustments go into effect. The confusion around this is around, is the FHFA, is the government putting in pricing that helps people with lower credit and hurts people with higher credit? And that's where I think a lot of the confusion is. And so I got a lot of things I'm going to talk about, Steve. And so I want to tee this up with some stories that have come out in the last 2 days. All right. So number one, the director of FHFA, Director Thompson, she's kind of like, she put out a whole statement on what she's calling just misinformation. And so what she said was this. She said, higher credit score borrowers are not being charged more so that lower credit score home buyers can pay less. That is not what is happening. And this is in response to a lot of people coming out and saying, people with good credit are paying more than people with bad credit. But here's my point. I don't think that's what people are saying. I think the criticism of these price adjustments is actually the thing that's being taken out of context. Let me explain this for a second. This is what we're talking about. And I'm going to share my screen because I think this is the best way to outline this. So let me find this really quick. So, all right, let me share this. You'll be able to see this. Can you see my screen okay?
Yeah.
All right, I'm gonna highlight the section so the audience can see this. If you're watching this on YouTube, if you are listening on the podcast, I will read what we're looking at. So this is from themortgagereports.com. It isn't, Steve, at least from my perspective, it isn't that the criticism is saying that people with more credit are paying more dollars. It's the percentage that was increased. So here's what it says. It says, based on the new LLPA matrix, someone buying a $400,000 home with a 740 credit score and 20% down, aka your perfect buyer, would see their fees increase on May 1st from $2,000 to $3,500. It's a $1,500 increase in fees. Don't know how anybody can debate that. However, a home buyer with a credit score of 640 with 3% down, or the buyer that barely qualifies, will notice a substantial fee decrease from $11,000 to $6,000. Now, what she is saying isn't wrong in that the person with worse credit, dollar for dollar, is in fact paying more dollars. But what I just showed you is undebatable. You agree?
100%.
And that's, I think, where the criticism is coming from. Anybody can get a calculator and say, is this percent on 400,000 more or less? My criticism of the changes on a show that we did earlier in the week or last week isn't suggesting that people with worse credit will pay less than people with better credit. It's just what I just showed you in the audience. I think this is the greatest example of the criticism. This is the pushback from your industry, which is the mortgage industry. And this is what the president of the Mortgage Banker Association just released. He said, this is a letter he wrote to Director Thompson at the FHFA. He said that I won't highlight it. Here you go. The third iteration of changes, however, will raise costs for borrowers in the heat of enterprises' traditional market. I'm going to talk about that in a second. And impose significant operational changes for the industry. The timing of these changes is especially troubling given current stress on the housing market conditions. And so he's talking specifically about DTI greater than 40%. And I think a lot of people, the FHFA is getting a lot of pushback on this. And I think they're taking the criticism out of context, quite frankly. Your thoughts on this?
So first and foremost, so the one for debt to income ratio, or DTI, over 40% got delayed, right? So I think they pushed that back to like August 1st. So whatever, right? I mean, you know, if you look at these, and like it's a 3/8 of a point bump at 740, at 780 credit score, that doesn't exist anymore, right? Like the 780 essentially became the new 740, right? So a lot of people are like, well, how do I get a credit score that high? Truth be told, you know, the credit scoring models that we use as lenders. So lenders always get the worst version of your credit, right? Like you could go to Credit Karma, you have a 900 score. You're like, dude, I got the best credit ever. I'm getting platinum Amex offers. I got everything, you know? And then you come to me and I'm like, look, dude, your 690 is going to cost you some extra money at closing, you know? Right. And so there's been a lot of changes in credit scoring. So we are seeing people that have good credit having a lot higher score, right? So I'm seeing more like 770s, 780s and things like that. So where 740 was the baseline, the 780 is now the baseline where you're paying the lower cost. But credit scores are also tending to report higher right now. And they've changed some of that weighting around. So you have that going for you. But there is no sugarcoating this or making this look good. You were charging Fannie Mae and Freddie Mac. They went into their model and they just put it out in like some dot matrix machine, and they put all the dots where like all their loans fall based on loan to value and credit score, and they raise the prices on their biggest market. And
so let me jump in right there. That's what you just said is exactly what I want to show the audience. So I'm going to share my screen again, and that is what Steve just said is I think what people are really struggling with, including myself. And so you're looking on screen at the new pricing changes that come in May 1st. Now, I want to direct the audience attention to this heat map. And on the heat map, it shows that the greatest increase in cost, we're not saying that these buyers are paying more. Anybody can do math. We're saying that the increase of cost by borrower is right what you just said, which is the heartbeat of the mortgage industry's the biggest market, which is people that have a credit score between 720 and 740 putting 20% down, because the story goes even deeper. And so I started to ask the question to myself, Steve. I said, well, that's interesting. Why was it that those two things got the highest increase in costs out of any other borrower? Part of it was because of what you just said, in that's where like most of the transactions are happening. So much so, I said, is that true? Is what I just said true? And I said, well, let's find out. So look at the screen yet again, and I did some research. What is the average, or how much money did people put down on the most recent home that they purchased? Ding, 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 ding. Almost 40% of the home buyers put 20% down or more. In other words, this is the largest pool of loans in the marketplace. And so anybody and everybody knows you want the truth, follow the money. So that's where my head's going at. My head's saying, okay, they went right after the mortgage industry's heartbeat of the business, which is that borrower 720 putting 20% down, which lo and behold, when you start to look beneath the surface, you start to pull back the curtain, we find, oh, that's the largest pool of loans. That's where the government's making their most money. So yes, I think it's fair to criticize the fact that those people were hit the hardest. That is undebatable. What am I missing?
You're spot on. And the other part of it is there's not a better part, right? With when you look at like as a business owner, right? And you're going to increase your prices and you're going to increase your, one thing you look at is like, okay, where's the most of our business, right? So we've got this group of people, we've got the heartbeat of the business, right? We also say, okay, if we raise their prices and these people say, forget it, I'm not doing a conventional loan, what are my other options? FHA, not going to happen. Non-qualified mortgage, not going to happen. Oh, I'll enlist in the Army, serve, 4 years on active duty or 2 years on active, whatever the VA requirements are, right? Or I'm going to do a rural development. No, they're still going to do like the conventional loan with the higher cost is still going to be their highest option. So the government, just being a business person, the government said, okay, this is the most of our business. We're going to charge them more money. And we know that they're not going to go anywhere else because this will still be the best option for them.
100% spot on. So well said. And that, I think, is what people are pushing back on. Again, going back to the heat map, that's exactly, I don't know how someone can defend that. I mean, it is clear as day that the pinpoint of the price increases, to your point, are where most people are getting mortgages. And the people that got relief, right, are the people with worse credit putting the least amount down. And I think that's the part that is raising concern for people like the CEO of the Mortgage Banker Association. Because if I'm you and I'm saying, okay, you just hit it. If most of our clientele are responsible with their finances and they have done well, it isn't that, and this is where I think people are taking this out of context, it isn't that we're saying that those people are having to pay more than people with worse credit. It's just that their increase in fees from what they were already paying, are being increased more than anybody else's. That is what is happening. That is undebatable.
Right. And truth be told, I mean, the stuff on the lower end of that spectrum. So like I have just, even yesterday, I was working on a loan site, an agent reached out. And he's like, hey, I got an FHA approved buyer, not getting our offers accepted anywhere. They're looking in kind of some different parts of like an older part of Detroit. So they're seeing a lot of like appraisal issues that would come up on an FHA loan. So he sent me a 641 credit score buyer. Guy had a low debt to income ratio. He had 3% down and he had like probably 6 months of reserves in the bank. So not a ton of reserves, but from a lending standard, pretty okay. And I couldn't get it approved on Fannie Mae or Freddie Mac with as much as 10% down. So even that, that they lowered those other buckets to make them more appealing for those lower credit score buyers. At the same time, the algorithm that they use to approve those loans has become more stringent. So it's like it was, they almost could have just left those buckets alone,
Wait, go back to that. Say that again. You're saying that the borrowers that these price changes are ideally, in theory, supposed to help, right? These people that are putting less down and have a lower credit score, you could see the price. The ones in green means that it got cheaper for them to borrow money, is essentially what that means. You're saying that the automated qualifying systems or the automated underwriting systems are getting harder on those same people?
100%. So like that the biggest improvement is under a 639 at 97% loan to value. So
1 3/4 points.
1 3/4 points better. That borrower, you never say never, right? But that loan, is never getting approved on a 3% down Fannie Mae or Freddie Mac loan with a 625 credit score.
So wait a
It's
minute.
never going to happen.
This is what I want to challenge. If what you said is true, and I have no reason not to believe you, then there's actually more that meets the eye to this story than even I thought it did originally. In other words, here's what I just saw. On paper, maybe the administration is saying, look, it's right here. We're helping all of you people. But in the real world, when it comes time to apply for a mortgage, it hasn't changed anything.
No,
have you thought about what I just said? Do you understand what I just said?
Yeah, it doesn't do anything. Everywhere that's green on there on the bottom part of that chart is a nothing burger. It does nothing.
But on paper,
it looks better.
It looks better. And so these folks that say, okay, maybe one would look at that and say, this is awesome news. We're trying to increase home affordability. We're trying to help those that need it. Look, we are doing something about it. We being the administration. In reality, It's done nothing, is what you're saying.
No, and the feedback is like, that's an FHA buyer, right? And the reason that's an FHA buyer is not because like I want to pigeonhole somebody in that loan program, or that's a bad loan program, or that's for bad buyers or whatever it is. And I know that in a competitive market, you're always going to take a conventional offer over an FHA offer. Like that's just the way this world works. And I'm totally with that. The thing is that the part that nobody's talking about in here is mortgage insurance, right?
Yeah.
So Fannie Mae and Freddie Mac have made these great changes, especially for the lower end of the spectrum. Well, a 660 credit score on a $200,000 loan with 3% down, you're paying like $250, $200 to $250 a month in PMI, in mortgage insurance. And you're probably getting an interest rate. Let's just say today, say you have an LLPA waiver, right? So we won't go into the weeds now, but say you don't even have to pay these points because you're a first-time home buyer and you make less than 80% of the area median income. You don't have to pay those points. Even at a 680 credit score, your PMI is probably 3 times as much as you'll pay on an FHA loan. So it doesn't have to do with an FHA being better because of your credit score in this spectrum. It's because there's a really good chance that that conventional loans, number one, with a conventional loan, there's no we meet box A, B, C, and D, your loan's going to close, right? It's all an automated underwriting system. And there's been situations, especially in those lower tier credit, again, why they're making such a big deal out of benefiting these people would be making this automated underwriting system less temperamental, because those conventional loans, you can lose that conventional loan approval and process, and then you have to go back to the FHA, and then it messes everything. Then everybody's freaking out, So there's way more that goes into it than that. But like you're saying, that's just fluff down there, like making those things better, trying to bring those buyers in. Maybe the stuff below, if you put down 20%, yeah, you're going to get a lot. That's a nice benefit on that heat map for those lower score buyers, and it does help in conventional loans. Maybe you'll get some appraisal waivers and some things to make it easy. But for any of those adjustments above 80%, it makes way more financial sense for most of those people under a 700 credit score to get an FHA, other than in a competitive market like this where people don't want to touch FHA loans with a 10-foot pole.
Yeah. Well, here's my question. My question is, if the goal of the Federal Housing Finance Agency is to make it easier for people with lower credit to get into a home, if that is the goal, and they come to a lender or a bank, and these pricing in the new pricing model that in theory is supposed to help those folks do just that, get into more homes, isn't helping people get into more homes because they can't qualify anyways, then wouldn't that suggest that the only people affected by this are the ones qualifying for the mortgages that are paying more in fees? And isn't the revenue that is coming from all of these mortgages being originated going back to the government coming from the same people that were paying before, but now they're just paying more?
Yes. Prices got raised.
And it only affects those people that were getting mortgages anyways. And I go back to the same thing that I just realized in this conversation is it's just a mirage.
Right.
Those people can't get a loan anyways. But on paper, look, we're helping all of you guys. Us here at the Federal Housing Finance Agency, we're helping you. You know, we're making it more affordable for you to get into a house, but you can't qualify on this. No one's talking about that, is what you're saying.
100%. And any loan officer that's been doing it for a while knows that those are FHA loans all day, and it's not because we don't like conventional loan is easier for everybody involved. Seller, me, buyer, agents, title company, everything is easier.
Everybody, yeah.
Everything to do a conventional loan. But when you're strictly looking like, right, you call like a fiduciary perspective, right? Like you're trying to find the best possible terms for that buyer where they're going to pay the least amount of money for the house or make the house as affordable as possible for them. And then mix that with what's going to be like easiest for them to do at the same time. And by easiest, I mean a process where we can say up front, you are going to close at these terms. And at the closing, we end up with those terms, right? Like there's no switching. Those lower end buyers, that's the FHA loan.
So you're saying, let me just make sure I hear what you're saying. What you're saying is, as a result of the changes in pricing that come into effect May 1st, does not help lower credit buyers get into homes the way that it was designed to do, and that the people that are already buying houses, it just became more expensive.
Yes, 100%.
That's it.
Yep. I mean, there's no doubt that if you are on the lower end of that heat map where it's green and you qualify, so maybe you've got a whole bunch. So lending it really relies on reserves, right? Especially for lower ends of these borrowers, like big retirement accounts and different things like that. How much money you have in the bank that you're not using toward the transaction that you'll have in case something bad happens. Like how many months can you make payments out of money that you have? That's what Fannie Mae and Freddie Mac like. The situation, though, is that a lot of times, in most cases, there's always the one-offs, right? But in most cases, if you have a 648 credit score, there's a really good chance you're also not fully funding your retirement, or you're not saving, 20% of your income before you pay bills and everything like that. Yeah, there's like a correlation there. It's just bad financial habits, and that may be because that's all you know, or you may have had something bad happen. And again, you go back to, okay, something bad happened to me, and we don't have the best situation right now, but we've always been really good. Well, great. You'll do an FHA loan now. We'll get you into conventional loan later. But this is a solution that is less expensive for you. And on top of that, FHA made their loans more attractive. So they lowered their monthly PMI rates, and FHA loans run at low rates. So this isn't a big commercial for FHA loans. I'm just saying that, yes, the more well-qualified people are absolutely taking the brunt of this. And that is just, it's a business move. Like these are Fannie Mae and Freddie Mac. Like I've said before, they have CEOs, they have boards of directors, they have shareholders, they have all these things. So the goal of those companies is to make as much money as possible with as little risk as possible. Isn't that 100%. What business is, right? And so that's what they're doing.
Yeah, this buyer right here that has a credit score under 640, that is putting 3% down, that got a 1.75% break on the cost of their mortgage, can never get this mortgage.
No, they're not getting that loan.
They got to go to FHA.
Yeah, they'd be way better.
To me, that's what we're talking about. That's the story. Yeah. Because all of this is all irrelevant anyways. And I guess I didn't realize that until literally we're just talking about it. That's the story. And bottom line, it's just the people that are getting mortgages, conventional mortgages anyways, just have to pay more. This did not do what I think their goal was, which is to help more people get into homes. That's what they're saying that the goal was. What's that?
The goal was to make more money, not to get more people into homes.
Well, that's not what's being. That's not how it's being positioned. How the FHFA, the director, comes right out in her statement on April 25th, 2023, and talks about that this is designed to help people get into more homes, to help home affordability. I mean, that's why they did this, is from my understanding. Is that correct?
Yeah.
And
That's what they
it's
say.
not
But I
doing
mean,
that.
it's certainly not. I mean, if that was truly their goal and this is the outcome, then they have missed so badly.
Yeah.
I mean, it's
That's
like,
my point.
and the other thing, like I said, this lenders have had, so for anybody that's watching, that's a home buyer or that's a real estate agent, and you're working with clients that are buying homes, like everything that anybody that's been pre-approved within the last 60 days is already priced into their loan.
Right.
So, and that's because these loans are, a lot of lenders put this in place because of it's loans that are sold to Fannie Mae and Freddie Mac May 1st and after. And a lot of times there's like all kinds of hangups that don't allow loans to get sold to Fannie Mae and Freddie Mac right away. Inevitably, all conventional loans get sold to them, but there can be missed documents and maybe the lender collects the interest or servicing fees. And so there's all kinds of back end stuff that happens that may not be why a loan gets sold to Fannie Mae right away. But lenders are money makers. They lend money and they make money, and that's all they do. And they are going to look at these loans and figure out the absolute best way for them to make the most possible money is to put these fees in place long before they could stand to lose money. And so we've already seen that. I have already written loans that people had to pay more because their debt to income ratio is higher before they rolled that back. And we ended up getting that. Once they rolled it back, that fee was backed out of that loan before it closed. And so they do the right thing in that way. But this is nothing new. And that's what's funny, even about the National Association of Mortgage Bankers. You read that person's letter that he wrote, like if this was something you were so worried about and you're so passionate about, and you're going to write this letter, why are you writing it now? Like, I'm just a lowly loan officer. I'm just one of the millions out here, like trying to make my way. And I've known about this since the middle of February. Like you should write your letter then before it's too late. It's all nonsense. It's all it is that FHA came out and they made a business decision to make more money on the people that use them the most. Like that's all it is.
Steve, we thank you so much.